Hello, everybody. Welcome in. It is Thursday. We have a big story. At the very end, there is a Bitcoin part to this as well. But warning in advance, I'm going to paint a very horrifying picture. And a lot of the data will be US centric. But the same stuff is happening all over the world. So a big thank you to everybody for joining. Thank you to the mods in the chat. Let's go. This is called... It's part of my macro series. I don't do macro often, but when I do, they say it's really good because I encapsulate everything. Anyway, we are in a very dire debt situation, and it is a ticking time bomb, and I'll show you exactly how. And of course, this doesn't matter. Don't forget to subscribe. You need to be well-rounded in the world of investing. You can't just be maniacally focused in one area. You need to know what's going on with the macro so you can prepare you and your family's future. So let's talk about this. This is stunning. All right. In just 1 week, we added 200 billion of debt. And I know because I've been preparing this deck for over a week, I had to update this chart. A week ago it was 34 trillion. Now it's $200 billion higher in a week. And that is 1/5 of $1 trillion. All right. Now the average salary in the US is $50,000. So basically, the US national debt added 4 million annual salaries in 1 week. I don't know if that's alarming. It's pretty alarming to me. Like they're throwing billions around like it's, I don't know, drops in the ocean. Anyhow, let's talk about some other stuff. Now, we often don't agree with Nassim Taleb. He is not a believer in Bitcoin. By the way, Bitcoin is pumping like crazy over the last 2 days. It's now $45,600, and it added $1,400 today, and another 1,000 or 1,200 yesterday. So it's crazy. But Taleb is a Bitcoin hater. But he does say, Nassim Taleb says, U.S. faces a death spiral of swelling debt. We know that. We've been talking about that for a long time. But he's respected in the old world, and we'll see. But he's not the only one who's concerned about this debt. Even Jerome Powell agrees. For the first time ever, a government official got up and said, the U.S. admits the U.S. economy is on a fiscally unsustainable path. Hat tip to Simply Bitcoin for putting this together. It's a very alarming 20-second video you can find on Twitter and stuff, which I didn't find there. Jeff Hammer, thank you for coming, my friend. So let's talk about more. Let's look at the markets so far around the world this year. It's been rough. Global stock markets have performed poorly so far, with the exception of Japan, the US, and India. But where stock price indices have all reached historic highs. However, places like South Korea, China, Hong Kong, Thailand, Australia, emerging markets in general, Singapore, Mexico, UK, France, Argentina, Europe, Germany, Peru, Taiwan, Israel, Philippines, everybody's getting hammered. Indonesia, very few markets are in the green so far this year. And that's a kind of sign of what's happening. And this is a global story, but a lot of the data I will show you will shock you. And it's very US centric, but the same applies, as I'll prove later, all over the world. So let's talk about GDP first, because this is how much a country produces. Think of it as product, output. And Goldman, the good news is they do believe that the Fed will cut interest rates 25 basis points in March, May, and June, followed by quarterly cuts to a terminal rate of 3.25 to 3.5%. But despite the jawboning from Jerome Powell, who thinks everything is fine until he doesn't, like he did a minute ago, things are concerning. But rates will be cut, according to Goldman, despite Jerome Powell saying higher for longer. But really, what's happening with inflation, which is the reason for these high rates in the first place, is they're coming down hard, real hard. This is the CPI versus PCE, and the headline year-over-year change in core PCE suggests that inflation continues to head towards the Fed's 2% target, but on a 3-month and 6-month annualized basis, it's already there. Things are coming down fast. Another proof of how fast things are coming down, I did mention this, I think it was in Octa, how deflation is very dangerous. But these are the true inflation numbers. Shout out to the Truflation team. It's now at 1.41%, but the government's reporting 3.4% because they look at silly data, whereas this looks at real data across the world. Now, let's get back into output and growth and how it's all tied in together. This is, again, an alert from CNBC, and they say the US economy grew at a blistering 3.3% in Q4 while inflation pulled back. That sounds amazing. But there's a catch. Now, when you read the news and you think the GDP is on fire, we're all doing really well, yeah? So tell me, everybody out there, drop a comment below if you feel you got 3.3% richer in Q4 last year. Let me know. Well, if you're in certain assets, maybe you did okay, like Nvidia and some select cryptos. But anyway, that's what the world is kind of telling. But there's a catch. In fact, I'm going to talk about 5 catches to prove why this is not exactly true. So let's look at the first catch. And this is the latest estimate, 3% GDP growth as of January 26, 2024. Now, the initial GDP Now model estimate for real GDP growth in the first quarter of 2024 is at 3%. Not bad. But the initial estimate of fourth quarter real GDP growth has a huge range from 3.3% to 0.9%. So we don't know exactly where it's going to go, how high it's going to go, etc. It's all over the map. And we do know, what I've said in previous videos, all of the growth is happening within the government. Okay, the government's spending on itself and the government is growing. So you don't see like manufacturing or other industries growing as well. We'll talk about the banking industry in a minute too. Now let's talk about, this is the most startling thing, and it gets worse after this chart too. This is from Zero Hedge. This is the second catch, by the way. This chart shows you that Q4 debt increased 850 billion, okay, which is significantly larger than both the GDP increase and the budget deficit increase for the same quarter, indicating that the nation's debt is growing much faster than its economic output and government budget shortfall. And in Q4, budget deficit increased, I think, by 510 billion, so that the government is spending way more than it brings in terms of revenue. And that's a problem. A problem. $3 in debt creates $1. Imagine you have a business and it costs you $300 to keep the lights on every day and the doors open and the place staffed, but you're only bringing in $100. How long do you think that business can last? The answer is probably till the end of the week, unless something radically changes. But it gets worse. This chart, now, again, I did promise it's a Bitcoin story at the very end. So for those of you who have friends who don't understand what Bitcoin is or think it's a scam like Nassim Taleb, this is all you need to show them. Just this little picture here. Let me walk you through it. This is the third catch, by the way. The chart shows the correlation between the change in US debt and the change in US GDP. And each data point represents a year, with the change in debt on the x-axis and the change in GDP on the y-axis. Okay? What's crazy is the government is now, based on this chart, spending $10 to get $1 in product. Or put another way, for every dollar spent, they get 10 cents back. Now, I think it was Peter St. Onge, he talks about this as well. Your grandkids bought it all, and then some. To see why in the past 12 months the federal debt increased 1.5 trillion and only created like $500 million in product. In other words, everything else shrank, and it's even worse for Q4. And even the 200 billion that was increased in debt just in the last week. And remember, the GDP isn't measuring wealth, it's measuring spending, the production which is sold. So this is a severe, severe, severe problem. Now, let's talk about the other problem. Because of high interest rates, this is the interest projection that's been flying around Twitter, etc., to go to above $3 trillion by 2027. And that sounds, no, that's impossible. If that was a stock chart, it would be amazing. But no, we are above $1 trillion right now. We're about 1.04, 1.06 trillion, heading to 1.5 trillion this year, at least, because a lot of the debt is actually rolling into a much higher interest rate. Half is still at like 2.5%. Now, when the new debt rolls over to more short-term stuff, it'll be more like 5%. And this is going to explode. And this is what's actually very terrifying. So I put together the US, give you an idea of the actual US interest on debt. If it goes to 1.5 trillion, which I do believe it will, but this year at least, And compared to all the other stuff that the US has to spend on. National defense, 0.73 trillion. Social Security, 1.2 trillion. Medicare, 0.86 trillion. Assistance to individuals, 0.619. By the way, the first four I mentioned are all going to the moon right now. They're all going much higher while the tax base is staying flat. Then there's transfers to states, etc. But the most important thing is, again, fifth catch, I forgot to mention, is the interest on debt will probably exceed Medicare and national defense combined in 2024. The deficits are just going to explode. Nobody's making anywhere near ever as much money to pay this and taxes back. So it's really, really unsustainable. Kind of what Jerome Powell was saying. And the debt, the interest on the debt is going to go like this, and so is the debt. But there's a lot more. Some more sad news coming. So the world, planet Earth, is in a world of debt. Public debt around the world has been on the rise over the last decades, particularly the last two decades. And we've had cascading crises in recent years. We had the global financial crisis, we had C-19, and as a result, global public debt has increased fourfold since the year 2000, very much outpacing global GDP. So it's not just in the US, it's all over the world. Global GDP went up about 2.5 times, I think, whereas global debt went up 4 times around the world. And that includes many fast-growing economies as well. And this comprises general government, domestic, and external debt. And that's now 92 trillion. And developing countries, by the way, owe about 30% of this total debt, of which roughly 70% is attributable to China, India, and Brazil. Are they going to pay that back? Well, I don't know. It's a weird problem. And tied to this, too, the increasing interest rates and the C-19 change of how people work, etc., has brought a huge impact on commercial real estate, office space. And this has a knock-on effect too, but basically 14% of all commercial real estate loans and 44% of all office building loans are now in negative equity, underwater. In other words, the debt is now greater than the property value on all these properties. Think about that. And currently, US banks hold 2.9 trillion of commercial real estate debt, and the majority of which is held by regional banks. I'll talk about those guys in a minute too. Office buildings are down 40% from their highs, and commercial real estate as a whole is down 25%. And as rates rise, many of these loans are due to be financed, and commercial real estate has been beyond bear market territory. And the other problem is the banks can't even lend anymore to bail these folks out. If they do have debt coming up for renewal, it's a real problem. It's causing prices to tank really hard. We've seen top landmark buildings in major cities across the US sell at a quarter of what they sold for 10 years ago. And we used to think, real estate's a safe bet. Yeah, personal housing is, of course. But commercial real estate, office buildings, whoa, they are getting completely slammed. Now, let's talk about who owns the assets real quick, and we get to some other changes and some shocking statistics. So we have assets, but we also have a lot of debt. And many that own the debt also own the assets. Think of a human being, a person being a balance sheet. You've got assets on one side and debt on the other. And that's what this is trying to portray, the other side of the coin. So yes, they do have assets, and the chart shows the distribution of various types of assets owned by different generations in the United States in the third quarter of 2023, the most recent data I could get. And assets are categorized into 6 times. You got real estate, consumer durable goods, corporate equities, mutual funds, defined pension benefit entitlements, and defined contribution pension entitlements, private businesses, and other assets. But you can see here the blue piece is kind of the lion's share of everything for the boomers and corporate mutual funds. There would be the orange block and the blue block in the second column, and the silent and earlier. But the big thing is when you take the silent and earlier and the baby boomers, they own over $100 trillion of assets. Gen X has about 40 trillion, and the millennials have just under 20 trillion. And you can see the millennials have it's good to see the millennials have so much real estate. I didn't actually expect that to be the case right now. Now, the other problem we have, though, is on that debt, delinquencies are skyrocketing because there's so much debt, not only for the government, but the government can print more money to pay their bills. That's harder for individuals. You can't just pull $1 million cash out of the ATM to pay off your mortgage. And the gap in the above chart, this is the divergence between the deposits in the system and the treasuries for it, will fall on the banks to fill. And the banks will need financing for those purchases, leading to a constraint in the system. It's coming. The only way out of this is for the US government to materially slow the pace of its deficit spending, and that's not likely. That's just going to grow. It's a death spiral. That's not going to change. And to add fuel to the fire, the delinquency rates are suggesting a huge wave of defaults about to hit. And defaults will deleverage banks, causing the overall ability for banks to engage in treasury financing to decline. And that's from the Bitcoin layer. That's a huge, huge problem in itself. In addition, when we go back to the other side of the fence, you got the government and you got the household debt. And here you can see how the household debt has changed over time. What this basically says is the household debt has reached $17.5 trillion in the fourth quarter of 2023, and delinquency rates are rising, as well as the total debt has increased by 220 billion to reach 79 trillion in the fourth quarter alone, which is pretty staggering. Credit card balances increased by 50 billion in a quarter. $50 billion went on the credit card. That's over now 1.13 trillion. And mortgage balances rose by 112 billion to 12.25 trillion. There's going to be a reckoning at some stage, everybody. We don't know when, but these high interest rates are smashing a lot of people, and there will be that wealth destruction. So who knows what's going to happen to commercial real estate? It's definitely going to be bad. Personal real estate, residential real estate, I'm not sure, but there could be some buying opportunities in the near future. Now, tied to debt, another very scary statistic for you all to know is this. This is very sad, and this is from Jim Bianco Research. The richest 10% in the United States, and it's the same in the UK, it's the same in Australia, same in Germany. In fact, it's even more extreme in Germany and Switzerland from the data I've seen. But the richest 10% own 65% of all money and assets, all valuable things. But they only have 8% of debt. That sounds weird. On the other hand, 90% of people have 92% of the debt and only 35% of the assets. And what is worse is the bottom 50% own 56% of the debt and only 5% of the wealth. It's kind of crazy when you see, who has the money, who gives out the credit. That's the rich people. They lend and they make money off the people that don't have. Now, the other side of this as well is the distribution of assets, which is, as I hinted at before, the wealth distribution is getting worse. If you look at those lines going down over time, this started in 1990 to the year 2024, you can see it's gotten more extreme, the wealth distribution. The richer are getting richer. And this clearly shows that it's highly skewed towards the top end of the spectrum, with the disparity growing. And what I point out here as well, you can see the top 0.1% of the population. Then you have the top 0.1 to 1%. They're the top two bars, the blue and the orange. And then you have the next 9%, the big pink thing. All right. That's just the top 10%. So the richest 10% own 65%. And the bottom 50% only own 5.9%, and that is sadly shrinking as well. This is, again, alarming statistics, alarming data. Not only do the bottom 50% have no assets, but they have the majority of the debt, which is crazy. Now, as I mentioned, it's not just in the US. Canada has a huge problem. In fact, it's even more extreme here. So you can see Canada's entire economy is worth less than $3 trillion, but households have pretty much that amount in debt as well. So households in Canada have the same amount of debt as the entire size of the Canadian economy. Corporate debt is twice the size of the Canadian economy, and government debt is the size of the Canadian economy. So again, debt is everywhere. Now in Europe, it's also a ticking time bomb. They are well aware of it. They have had elevated interest rates, all the central banks kind of work in cahoots together. They all talk about this magical 2%. They all print at the same time. They all try and do QT, quantitative tightening, at the same time. They're all in the same problem. They all follow each other. The blind are leading the blind, and it's going to be a huge problem everywhere. Everywhere. China, EU, Australia, New Zealand, Canada, South America. As I shared, 70% of the debt is owned by these emerging markets, and the US as well. So, in addition, things are not getting better yet. But this is, shout out to Jack Mollers. He talks about the soft landing. The BTFP program, the bank bailout program, is ending. Unemployment is rising. Layoffs are rocketing. And he believes Bitcoin's going to go up because of all of this. But you can see here, massive job layoffs. I actually put a chart together with all the job layoffs. But this is the weakest January hiring on record in the history of the US. Job market is smashed. But you read government statistics that tell you everything's fine. No problem. We're creating lots of jobs. No. You're creating lots of Uber jobs, second jobs, third jobs, personal trainer jobs, people working gigs. They're the jobs that are happening. Full-time jobs are disappearing. Now back to commercial real estate. The big problem here is the US bank exposure to commercial real estate is at a new all-time high. $3 trillion. And all of that is underwater. It's got to blow. And what's worse is they're cutting the BTFP program off. And just this short list of banks here, these regional banks, okay, you start with New York Community Bank, hit the wall last week, falling 70% in a day approximately. They acquired Signature Bank, which hit the wall back in March when the crisis happened. But this list of these banks here hold 70% of commercial real estate loans. And just 10 months ago, the regional bank crisis ended? No, it has not ended. It's about to begin. That BTFP program ends, and some of these are going to hit the wall. Probably, maybe, but based on data, it says so, unless they get another bailout. Now, in other weird news too, this is the ISM. The January ISM services data was surprisingly strong across the board. With the prices paid, normally when this goes up, it's a good sign. But the question is, the bump, why did it happen? Well, the bump is because of inflation. And it's been driven by higher shipping costs and increases in commodities and service prices thanks to the Red Sea Calamity. All right, so this normally would paint a good picture. Prices going up for manufacturers, but it's not. Prices are going up because shipping costs have gone through the roof. They've tripled in the last month. So crazy news. Now, I always like to end on a happy note, so things will get better a little bit. Bitcoin did fall $100, so Bitcoin's listening to this news and not excited, but there's good Bitcoin news. So there is some good macro news. First of all, we do have insurance. All right, it's very clear. I always call this the Bitcoin Liferaft. It's very clear that money printing will continue. Debt will continue. We're way beyond the point of no return. So people do need a life raft, and that's why we Bitcoin, as I say as well, for a long time, which is great. In addition, there's other good news too. In good post-C19 news, this is from Ed Yardeni, who knows his stuff, Wall Street veteran. He looks at parallels between the Spanish flu over 100 years ago and C19, and he believes a growth boom is coming. So I always think it's a bit of a sketch to go back 100 years and build an analog. But anyway, I was desperate for some good news, so I pulled that one in too. And finally, another piece of good news too, is because rates are going to fall in the near future, the $6 trillion on the sidelines and money market funds, etc., getting that 5% yield. U.S. saving rates tumbled, I think, from 4.15 to 4.1, now to 3.7%. That's the lowest since 2022. So savings rates are now lower than they were all of 2023, which is good. Why do we care about this? Well, because of this. So this is a simple way to explain what happens when the saving rate tumbles from 5% down to 3.7%, the lowest since 2022, is people need to seek alpha. They need to chase alpha. Therefore, if they're only getting 3% in their bank accounts or less, sometimes zero, or money markets, they put it into risk assets. So that means as the rates go down, the money flow goes up. tried to visually make that logical. So that means more money into risk assets, which could bring markets up. And the combination of rate cuts will do that in many different ways, as well as the fact that the government has to print more money as we go forward. So trying to end on a good note. Hope you enjoyed the show. Big thanks to everyone on Patreon. We have a new Patreon member as well. Algo Desic says, became Patreon member recently. Amazing channel and guests. And speaking of guests, we do what the community wants. And the community asked for more interviews. And they asked in particular for British HODL. So tomorrow we'll be on the show at noon Pacific. And actually, I'll be on Cyber Bulls as well tomorrow. So you'll see that too. Recording today, right after this. So 3 videos in one day. It'll be fun. But this will be a fun conversation, especially in light of all the macro news I just covered too. So thank you all for all the suggestions. Thank you all for coming. Hit the like on the way out. I know macro is a dry subject, but you have to convince your friends and family that holding fiat is a fool's errand. It's a melting ice cube that will eventually go to zero. It's not a way to save. You need that Liferaft. You pull up that Liferaft as well. Make sure people know. Send this picture to your friends and family. And we're seeing that as well with all the action now on Bitcoin. And I made a video earlier. If Fidelity employ their model that they use up in Canada, speaking of Canada again, all the lovely Canadians out there, it's going to go bonkers. So it's going to happen. We just need to wait. And that's a big part of the game we play. Patience. Thank you all for coming. Thank you to the mods in the chat. I see our friends out there. Mr. Beijinger and TND Tesla and K8. Thanks for keeping us all safe. I'll see you all tomorrow. Twice. Bye.